All right, so are we all here? I think just about everyone is here. We have, I think, 10 people now. 2 people jumped in at the last minute. So I guess not every single person is here yet. Maybe we'll wait a minute. But in the meantime, what we might want to do is take a quick peek at the syllabus, which you should be able to see on my screen as soon as I open it up. And oh yeah, here it is. All right, so first things first, this is the derivatives class that we teach in this program. And I think you'll find it to be extremely interesting, although it's a little bit technical. A lot of the work can be done in Excel, which certainly makes it a lot less painful, shall we say. This is not meant to be a math class, so this is a very applied course, but the content is a little bit challenging. So I hope you have some good Excel skills because they'll come in very handy throughout this course. All right, a lot of the problems that we will be working on can be easily done in Excel. And in fact, it's, as you know, an excellent way of organizing your data. Okay, now, if you can see what's going on here, you can see that I've got all my information right here. And so, oops, looks like I opened up the wrong one. Oh no, you know what I just realized? I don't know what would happen. It looks like that's the old one, but that's all right. It's exactly the same. I'll update it. Whoops. Yeah, okay. So don't worry. It's the same exact content except for the dates. That's what caught my eye. This is spring of 21. And the dates are from tonight, which is the 5th of April. And the last night that we'll be meeting is, let me check. I've got it on my calendar somewhere. 8 weeks from now, whatever that is, that's when we're going to have our last session. I don't believe there's any days off in this session. We have from the 5th until there it is. May 24th is our last day. All right, very good. Now, the rest of this information is exactly the same. It's an online course, and we'll be meeting one night a week on Monday nights from 6 to 9, roughly. And so the book that we'll be using, and I don't believe they're on a new edition just yet, although we can confirm that. Let's take a look at Amazon for a second. Yeah, it looks like the 10th edition is as far as I've gotten already. Now, it actually, in a way, doesn't matter. I'll tell you why. This is one of those books where they update it every couple of years, whether it's needed or not. So if you have the ability to get your hands on an older edition and save a lot of money, I would recommend you do that because the chances are that whatever edition you have, it's so similar to the new one that you might as well go for it. Basically, when they update it, all they really do is add maybe a new chapter here or there. The chapters we'll be covering are in all the older editions. So this is what it looks like now. Oh, wait a minute. What's going on here? No, I don't think this is the right one. Hold on one second. What's going on here? I recognize some of these older ones. This is very strange. You can see there's so many editions. Well, all right, I'll tell you what, get your hands on whichever one you can and use that one because, like I said, they're all very similar to each other. And wow, I'm surprised to see there's so many of them floating around here. But don't spend a lot of money on it because, like I said, you can usually get a slightly older version, which won't cost an arm and a leg. And you'll still end up with the same content, especially because the majority of the content is just in my slides anyway, which you may have noticed. You should have received a copy of the slides for tonight, which I will do every week going forward. I know that theoretically we could use NYU classes, but I've had so much trouble with it in the past that it's just easier, as far as I'm concerned, to just email you the material myself. I will take responsibility for sending it to you in advance so you can read it up before we get started. Because like I said, it is a fairly complicated subject matter. And the more time you have to read, the better off you'll be, of course. So this is the official version of the book, but like I said, you can substitute another one if you can get your hands on it and save a lot of money. It's a really good book, though. Having said that, if you really are serious about this subject, this is maybe the best derivatives book in the market. Hull is really well known in this field, and the book covers a little bit of everything. And of course, you know, this is an 8-week course. We only have so much time. But this book has like 30 chapters or more. So he really covers a little bit of everything in there. So I'm sure that if you worked in a bank or a place where people are dealing with derivatives, you'll find that somebody in that building has a copy of this book because it's that important. Now, the software here, we're going to use Excel for our problem sets because it is so convenient. And in some cases, we'll need the mathematical functions. In some cases, it's just a question of drawing graphs that will help us visualize what the material looks like. And in other cases, we may simply want to organize our material in Excel. Now, by the way, I just want you to notice here with the Zoom that we're using here, it has this really interesting feature. It allows me to create polls on the fly. So just for the fun of it, I'm going to do one right now, just because it might be actually helpful information for me. I'm going to ask you a very simple question. How strong is your Excel background? Now, you don't worry about it if it's very poor, because we're going to cover everything as we go along. Non-existent, I guess, will be my first choice. Weak, fairly good, good, really good. Okay, so those will be your choices. Now you'll see, we'll get a chance to find out how this polling system works, and I get to find out some useful information. So look, why don't we do this right now? And just take a minute and vote. I'm dying to know how strong your background is. Okay, good. All right, well, that's not bad. I mean, that's better than I expected. I was worried that you'd all be saying non-existent. Okay, so as long as you've used Excel before, you can do what we're going to do. You don't have to, there might be a few special features here and there that I have to show you, but okay, this is very good news. I'm glad to see this. All right, so there's Excel. Now, what are we actually doing in this class? Well, we're going to be looking, obviously, at derivatives markets, although the majority of the coverage will be of options, because options are by far the most complex of all the derivatives, but they're also the most powerful and useful. So we'll need to spend a lot of time analyzing options, but we'll certainly spend a lot of time covering all the others as well. So let me scroll down here. And okay, there's all this boilerplate language here. So we're not just going to be learning how these products work. We're going to learn how they can be used for hedging risk, but also what strategies can be employed to trade them and hopefully earn profits. But the focus towards the end of the course moves into the area of pricing models, where we try to understand how to price derivative securities. In other words, we want to understand not just what they are or how they work or how they can be used. We also want to understand how options, especially, are priced in the market. And this is where it starts to get a little bit more complicated. At the very end, we'll also be introducing what I'm calling here the Greek letters. This is actually an introduction to risk management using derivatives. Okay, so by the way, I also want to point out here that some of these topics take longer than others, and in some weeks, the material might spill over into the next week. And in some cases, it might be the other way around. We might finish a little early and may have to start another chapter in order to avoid wasting time. So in other words, the setup here isn't perfect yet. It might take some weeks, we might spend a little more time on this material, sometimes a little less. So think of this as only an approximate outline. In fact, it says it right here, the discretion of the faculty, the syllabus may be modified to better meet the needs of the student. So in other words, if we have to spend extra time with one of these advanced topics, that's fine. We'll make up for it the next week. Okay, so it's not quite as rigid as it looks. Now, there also are a series of assignments that your grade is primarily based on. Rather than having a massive project at the end of the course or a paper or something like that, I think it's easier to simply have a quick assignment, relatively quick assignment each week for the entire 8 weeks. That way the work doesn't pile up. You don't have to worry about cramming for exams, and it gives you an opportunity to get your hands on Excel for the most part. So I like this approach. And I think you will too as we're going along, when you realize that you're not spending half your time studying for exams or writing papers. You're learning the material. And that's really the bottom line. Okay, so what else do we need to know? Well, you will be getting a grade for this class unless you specifically asked for some other type of grading scheme like pass-fail. And if you have, I would already have it in my roster. Other than that, I think we're good to go here. There isn't much else that we need to cover, except for one thing. This class is being recorded. It is, after all, a Zoom session. If you can't be here, or if you're late, or something goes wrong, or if possibly you just want to review the material, all of these recording sessions are being stored in my YouTube account because I just find that it's easier that way. I know theoretically I could put it somewhere, and one event will use many websites, but again, I just find it's so much simpler to keep everything together in one place. And so if you look and see, this is my website. It's, if you search for my name, let's try that. Hold on one second. I'm curious myself to see how this works. Oh no. See, now there's the problem. There's apparently a basketball player with my name. So instead, don't do that. Don't do what I just did. Go to YouTube first and then look for my name. Well, this is already in my account, so I can't really, how would that work? I guess you would type it up here. And it comes, okay, here it is, here it is. So just go to this red dot. And then what I've got is all the categories here. Now, after tonight's class, after I store the first recording, I will create a separate playlist for our class. Otherwise, you're going to have to sort through a million videos. You don't want to do that. Believe me, I have 5 other classes going on as we speak, and all the videos are all jumbled together here. There's a lot of them. So in order to avoid you needing to go through them all, there'll be a separate playlist with our name on it, which you can find. And then all of the videos will be stored in our playlist. Okay. And watching them, you know, it's purely optional. It's up to you. If, like I said, if you've attended the class, there's no real need to watch the video unless you feel a particular need to do so. All right. And one more thing too, it is a very long class, and it's late at night. It's Monday. Everybody's getting tired already. So it's the first day back to work. So we always have a break in the middle of this class. We have to have a break. It's just, even if it's not that long, you need to have time to get some refreshments to carry on with a class of this complexity. So somewhere in the middle, around maybe 7:30-ish, more or less, or depending on the content, we'll stop, and then we'll, you know, get some refreshments, and we'll come back and we'll finish up the material. We're officially scheduled to run until 9, but like I said, some weeks we might finish a little early, but we won't ever run long. If we need more time, we'll just pick it up in the following session. So you don't have to worry about that. We're never going to, you can make appointments that start at 9 o'clock, for example. But, you know, sometimes we might run a little long, especially a little short, I mean, especially early on. All right, now you all have a copy where I did send notes to you by email, if you did not get them, what you need to do is immediately let me know, because that means either it went to your junk box or else there's a problem. I may have made a typo in the roster, which happens all the time, as you can probably imagine. It's hard to be sure if a name is spelled right because there are no rules when it comes to names. You know what I mean? Um, so let me just go look at, where's my website here? Hold on. I've got so much stuff open here. I can't find it. Here it is. Here it is. This is my NYU account. So if you've sent me an email, I'll see it right in here. So if you do not have your notes that I emailed you, just send me an email. The address is listed right here on the syllabus. And just say, I did not get my materials. And then what I will do is I'll check my roster to see if I made a typo. And in the meantime, what you should do is look in your junk box, because anytime there's attachments, there's always a risk. Here we go. I did. Did you not receive it? Did you get the slides?
I got the slides and the assignment, but not the
Did I
syllabus.
forget to attach? Oh, you know what? I may have forgotten to attach it. Let me do that. I'll tell you, when we're done, I'll send it to you, because the one that I was sending out, I just realized now, is the outdated one anyway. I'll tell you what I'll do, because I just realized to my horror that I forgot to update this thing. I'll send everybody a copy of this new version later on. And but you notice that all I changed was these dates anyway, now that I think about it. And this, it's because it's exactly the same. But yes, I will send everybody a copy tonight after we're done. Okay. I probably was in a hurry. I forgot. I want to make sure you got the invitation and the the notes. I figured that was the most important thing, but of course you need this too, especially if you're getting reimbursed at your job, which I hope you are. I used to work and go to school full time at night or part time at night. I know what it's like. It's tough, but it has to be done. All right, so that should be that. And yes, you can, by the way, if you've never used Zoom before, you can send a message to the chat box anytime. You can address it to me where everyone can see it, but you can also, there's a way to make it private so that only I see it. I don't exactly know all the details because I'm not a high-tech person by any means, but it can be done. There's also a way you can raise your hand. And I don't really know how that works either, but it can be done. All right. So anything else? I don't think so. All right. Well, let's get cracking here. So we're going to look at our first introduction to derivative securities. We need to figure out what they are in the first place and why they're so important in finance. Oh, you know what I forgot to ask? What exactly, I know that they offer several programs, but I don't remember all of their names. So what, I don't know how to ask this question without, I can't do a poll because I don't remember the names, but just out of curiosity, what is the actual name of the, what is it called, a certificate now that you're getting? I don't remember either. They changed it very recently. Are they calling this a certificate now?
It's a certificate in investment management.
Ah, there you go. Perfect. All right. Is everyone else doing the same thing?
I'm not currently doing a certificate yet, but I know that like at least one other one is alternative investments.
Oh, okay. That's good. Well, you know what? The thing is, alternative investments, a lot of them will have features that are in common with these derivative securities. And so I think you'll find that this background will be very helpful when you get to that course. Because what makes them alternative is that they have very unusual features compared to traditional, let's say, stocks and bonds and that type of thing. So a lot of the same logic will apply to those alternative investments, which is very helpful. And so, all right, I was just wondering, so nobody's here is doing something completely not finance related? Nobody's doing this just out of curiosity? That's okay. All right, so why don't we get started? We will need to first introduce ourselves to the whole field of derivative securities. They have quite a reputation, don't they? If you were to just glance through the headlines, what do you think? Do they have a good or bad reputation in the marketplace? Or have you not run across them? Has anyone ever run across any discussion about derivatives in the media? Like, for example, why don't we look real fast at one of my favorite financial websites, which is cnbc.com. And we can see that there's a lot of useful information here. Let's see, they've got options. I don't know what that is. Huh. Yes, so there's all kinds of information on this website. It looks like they have a separate section for options. They have all kinds of nice stuff here. They have information about US markets, currencies, crypto. Apparently Bitcoin is going through the roof. And I don't have the slightest idea why, but they are. And yeah, all these different categories are right here at your fingertips. Investing, there's options down here. Technology, well, politics, you can get that anywhere. But so yeah, if you're interested in reading about the markets, one of the best websites I think is cnbc.com, and you'll get a little bit of everything there. Some of these websites are really just about stocks, and that's fine. But if you're really interested in derivatives, you probably should look at more different types of websites. But anyway, so let's see what derivatives are all about. So we'll start out by identifying the 4 basic types of derivative securities that trade in the marketplace, of which there are forward contracts, as you can see, futures contracts, swaps, and options. Now, it turns out that the first 3 are relatively closely related to each other, and they've been around for quite a while. Forwards and futures, they have a very long history. Even in the United States, which is, of course, a relatively young country, swaps were created in the early 80s, and we'll talk about that when we get to that point. Options have been around in the US for a while, but they really only got started trading heavily in the 1970s, and there's a reason for that, which we'll discuss when we get to that point. So the forwards and futures contracts are the most basic types of derivatives. They're very easy to use for hedging purposes. Originally, all of these securities were designed for hedging purposes, which means you're trying to take steps to reduce or eliminate your risk. And these instruments were specifically designed for that purpose. That's why they were created in the first place. But it became clear fairly quickly that they could also be used for what we call speculation. Okay? Speculation simply means gambling. So in other words, the nice thing about derivatives, depending on your outlook, is that you can speculate on the future direction of many different kinds of economic variables. Like, for example, let's see. Let me sneak this in here for a second. Derivatives can be used for 2 main purposes. I'll just add this to our existing notes. Number 1, hedging risk, and number 2, speculating or speculation. Okay, and so what does that mean even? Oops. That's one of the annoying things about this thing. It's very hard. It's always getting in the way. All right, here we go. All right. So what exactly do we mean? Well, just in the briefest possible terms, hedging risk means that we are attempting to reduce or eliminate our risk. And we'll see a lot of this throughout the course. So hedging is designed to reduce, or eliminate the risk of a portfolio of assets. Now, it could be for other things too. Like, for example, when you buy life insurance or auto insurance or, homeowners insurance, it's all about reducing risk. But here we're specifically thinking in terms of the risk of a portfolio of assets. Now, speculation, on the other hand, speculation involves taking a position in a financial asset in order to hopefully earn profits from, that's probably good enough. To hopefully earn profits. In other words, you're gambling. You're taking a chance. Even if you buy a single share of stock, you're speculating. You're guessing that the direction of that stock is up in the future. So it turns out that derivatives are particularly well suited for both of these activities. Derivatives are very powerful and flexible hedging instruments. Okay, they can be used to implement strategies that would be impossible with other types of financial assets. That's one of the big deals about them. They're very powerful and flexible. They're designed for exactly this type of thing. At the same time, though, they're also extremely useful for speculation and are highly leveraged, which means that even a small change in the value of an asset can lead to large gains or losses for two derivative securities. In other words, it's basically a way of, it's sort of like gambling on steroids. It really, you can use these to really go crazy and gamble like you would never believe was possible. So if you're really trying to make a lot of money in a hurry, this is one way you could potentially do it, because it doesn't take much for these derivatives to gain an enormous amount of value, but it also doesn't take much for them to lose an enormous amount of value. Unlike, let's say, the underlying securities like stocks or bonds, whose prices are, even when they bounce around a lot, by comparison, those prices are fairly stable. So we'll discuss that as we go along. But the idea here is that derivatives can be extremely volatile. And in fact, we'll discuss this as we go along, but there have been several historical episodes and I mean in the United States mainly, but there have been several historical episodes where speculators have lost enormous sums of money with derivatives. For example, and I'll just mention this briefly because this is an event that has been written about extensively. The bank, Barings Bank, which no longer exists, by the way, was bankrupted by the trades of a single, or by, I should say, the activities of a single trader in their Singapore branch. This individual, this trader, managed to lose over $1 billion of the bank's capital in a matter of months. Well, that usually means bye-bye to that company. So Barings Bank was bankrupted by this trader. Now, part of the reason why this was possible to happen is that they decided, now Barings, a little historical background here, Barings had been around, and you've probably not even heard of them by now. Barings had been around for over 200 years. In fact, they did extensive business with the Queen of England, and they also helped the United States finance the Louisiana Purchase in 1803. So that goes to show you just how long this bank had been around. Now you might remember that in 1803, the United States bought Louisiana, the Louisiana Territory, from Napoleon, and it cost relatively little money, $15 million. But the United States didn't have $15 million at that time. Where did they get the money from? They issued bonds, but the underwriter for these bonds was the Barings Bank. Okay, so they were the ones who helped do this. And in fact, interestingly enough, there used to be a museum in the Wall Street district called the Museum of American Finance, which sadly enough, the building was destroyed by flooding. And so they're currently searching for a new home down there. But one of the many items they had in their collection was actually a bond issued by Barings to help finance the Louisiana Purchase. So it was kind of cool that they had one in their collection. So what actually happened here was that in the 90s, early 90s, mid 90s, I guess, Barings decided to open up a trading operation in Singapore. Okay, they chose a trader named Nicholas Leeson to run the branch. Okay, now here's where they ran into trouble. Unfortunately, he was put in charge of both the front office and the back office. What does that mean? In Wall Street jargon, the front office is where trading takes place. The back office is where the accounting information is kept. In other words, Leeson was in charge of both of them. Now you can see where this is going, I bet. The guy was not very good at trading. I don't even remember why they picked him to do this. Maybe he's the only one who was willing to go. But unfortunately for Nick Leeson, he got himself involved, placed many questionable bets on different economic variables, such as the Japanese stock market index, or called the Nikkei 225, the main Japanese stock market index. And since he was using derivatives, his losses piled up very quickly. Okay, so here's where the problem is. Normally, all this information would be sent back to the branch, the headquarters in London. So this is where he got himself really into trouble. Leeson sent fraudulent statements back to the London headquarters in order to cover his losses. He figured, well, you know what I'll do? I'll just keep trading. Eventually I'll get out of this, and then I'll settle up with them. I can, when I break even, I'll be fine again. But it didn't happen. No, he just kept getting worse and worse and worse. So that by the time, I believe it was the spring of 97, eventually the losses reached the point where he could no longer cover them up. And the bank was all the bank's capital was lost. It was sold to ING for £1. And that was the end of Barings Bank. And so it was all because of this one trader who really didn't know what he was doing, but even worse, he had the ability to cover up his losses until it reached the catastrophic point where it was all over. The bank was ruined. Okay. So, but if he'd been trading stocks or bonds or something like that, none of this would have ever happened. He couldn't have possibly lost this kind of money if he was playing with normal securities, but because he thought he knew what he was doing, he really gambled away, in effect, the bank's money. Now, a movie, if you're interested in this actually was turned into a movie. This episode was turned into a book and a movie called Rogue Trader, which you can actually go get on Netflix and watch it and say, hey, how did this happen? What's going on with this guy? And it was actually it was very well done, I thought. So unlike many other of these scandals, many other trading scandals, Nick Leeson actually spent time in a German prison, which is very unusual. A lot of these guys just get fired. They can't be sued because they don't have that kind of money. So, but he actually did spend time in jail. And then now, of course, he makes his living by going to banks and explaining to them how to spot rogue traders. How about that? All right. So I just thought you'd find that interesting. And it's not the only time something like that happened. There were quite a few of these cases in the 90s in particular. But why don't we start at the beginning here and describe what a derivative security really is? We know that the four basic types are listed here, but we want to understand what exactly is this thing. I mean, in a nutshell, it is a contract, but it's the way the contract is worded, the way it's structured, that really gives these things their characteristics. So a derivative security is a financial asset like all the others, but its value is derived from some underlying security, like a stock or a bond, let's say. So in other words, it doesn't have a value of its own, except how is it related to some other security, like a stock or a bond. It gives you the right to do something with that asset. You might be allowed to buy it, you might be allowed to sell it, you might be allowed to convert it into another security. You might be able to buy it for different prices at different points in time. So the value of the derivative depends on what you actually are being given the right to do with that security. So what's interesting about these derivatives is that initially they were very simple. They were based on stocks, maybe bonds. That was about it. But pretty soon it became clear that they could be extended in many different directions. So, for example, the underlying security could be a commodity like gold or oil. They can also be written on indexes like stock indexes. They can also be written on interest rates. And they can also be written on assets that are not really assets at all, that even are nothing to do with finance, like the average temperature or how much snowfall do we get. So derivatives, like I was saying before, are so powerful and flexible because they can be, in a sense, tailored to anything that an investor wants. Whatever you want, you can have it in the derivatives market. The question is, how much do you have to pay for it? And what can happen if there are dramatic changes in the value of that underlying security? That's what you have to worry about. All right. So you can see, for all practical purposes, when it comes to derivatives, the sky is the limit as to what you can get yourself involved with. That's one of the nice things about them. And especially for people who need to hedge very obscure types of risk, like if you're doing a lot of business in a small third world country and you need to hedge the risk that that currency will gain or lose against the dollar. There may not be a lot of interest in the world's financial markets, let's say in the Peruvian sol, but if you are doing business in Peru, you need to have some kind of protection against fluctuations in that exchange rate. And you can certainly arrange to buy a derivative whose value depends on the sol. Okay, Now, some derivatives are bought and sold through organized exchanges, and others are negotiated directly between counterparties. Okay, so now you know that, of course, stocks trade in organized exchanges, but these are specialized derivatives exchanges. In other words, you cannot go to the New York Stock Exchange and buy derivatives. They don't have them. But where can you buy them? Well, in the United States, we have the Chicago Mercantile Exchange. In New York City, we have the New York Mercantile Exchange, although they primarily focus on energy derivatives. And then we have the London International Financial Futures Exchange. And of course, there are many others as well throughout the world. And this is where you can come and buy derivatives through an exchange. Then we also have the rest, which are traded in the market directly between what we call counterparties. In other words, if I need a very bizarre derivative and it's not trading on any exchange, all I have to do is pick up the phone and call any investment bank and say, listen, guys, I need an option that gives me the right to buy Swiss francs, but only if only if the Dow Jones goes above 35,000 or something like that. And they'll say, all right, fine, we'll sell that to you. And then here's how much you'll pay us for it. And so you sign the contract and there's your derivative. It's readily available. You can go to any one of them. They're all dealers in this market, and you can customize it to anything you want as long as you can find somebody who will sell you that product. They're okay with that because they will charge you a price that makes sure that they earn a profit from you. But if you're in the type of business where, you know what, it depends on the Dow and the Swiss franc, you want to have the ability to enter into one of these contracts. So that's the so-called over-the-counter market where they're negotiated directly, where I, as a customer, call up the investment bank, tell them what I want, and all they have to do now is tell me how much it will cost me. Okay, it's almost like having customized furniture built for your house. You know, it's just somebody is out there who is willing to do it for you. It's just a question of how much does it cost. Okay, now, or, you know, anything you might ask for. So what I'd like to do, though, is show you the website for the Chicago Mercantile Exchange real fast. This is one of the biggest in the US, if not the biggest derivatives exchange in the United States. And so what they'll do here is they'll have, and we'll go through these as we need them, but they have a list here of the notionals. These are some of the different categories that you can buy through them. They have all these different derivatives based on these major categories. And you can see that, just as an example, the volume of foreign exchange derivatives is, and this is per day, $78.7 billion every day. The equity index, meaning, let's say the S&P 500, $717.1 billion per day. Energy, $137.8 billion per day. So you kind of get the idea that this is a very active market. And it is. So you can go through here and find a list of all the different types of derivatives that they have. For example, we see over here crude oil futures, mini S&P 500 futures. What do we have over here? Agricultural futures, corn and soybeans, Australian dollars, Euro dollars, which we'll discuss when we get to that point. Those are the futures. I don't know what they did with their options, but they're on here somewhere. And so what's nice about this website is that if you want to learn more about derivatives, there's this category here called education. And here they have all kinds of material that you can download and learn at your own pace. Look at this, and they're all free. Why do you suppose it's free? What do they hope will happen when you're done with these courses? God, there's so many of them.
That you'll buy or sell a derivative?
Yes, you'll get involved in the market. That's how they make their money, by the way, with volume. They want lots of people to buy these derivatives because they basically make money whether you buy them or sell them. They're making money no matter what you do. They want to encourage you to buy these products. It's like if you've ever been to a casino, they'll always have a room set aside somewhere where they actually will teach you how to play the different games for free, I mean. And then they're hoping that you'll go out on the floor and lose all your money. But they know that you may not want to play if you don't understand the game. So they'll train you if they have to, but they want you to just sit there and play. All right, anyway, so, but yes, you can download all this stuff for free if you want to learn more about all these different products. And so anyway, so the basic types, as I said before, forwards, futures, swaps, and options. And so we're going to start, of course, with forwards. A forward contract is an easy, conceptually a very easy product to understand. It's an agreement. That's all it is, to either buy or sell an asset at a specific date in the future, but where the price is agreed to today. Okay, that's the key to the whole thing. The price is agreed on today. So what I can basically do is lock in the price at which I can buy or sell something in the future. That's the key to the whole thing. And it's a contract, though. So in other words, if I change my mind, well, I may be in trouble. I'm locking myself into an agreement to buy or sell something in the future. So let me show you a very quick example of this. Suppose that at the moment, the spot exchange rate between the dollar and the pound, and this is obviously too high for what's going on right now, but let's just say that at the moment, I could buy as many British pounds as I want for $1.69.80 each. The 6-month forward exchange rate, which we'll explain in a minute, is 167.15. Now, what does that mean? Now, this is the number that you pay. Let's say you go to London and you don't have any pounds in your pocket. So you go up to the local bank and say, here's dollars, please give me pounds. This is how much they'll charge you for those pounds. On the other hand, if you decided to enter into a 6-month forward contract to buy British pounds or sell them, this is the price that you will either pay or receive. So that's the price at which you can arrange for future delivery of the British pound. And if you notice, it's not the same, is it? No, it usually isn't. We're going to find out in a few minutes what is it that's causing the two numbers to be different. And I'll give you a hint, it has something to do with interest rates. So yes, this means, again, that you can buy all the pounds you want right now for this price. If you're willing to wait 6 months to take delivery or make delivery, this is the appropriate price. But this one requires you to enter into a forward contract where delivery will take place in 6 months. Now, I do want to point out that at least in the foreign exchange market, it's usually not quite this simple. Currencies are usually bought and sold with what are called an ask price and a bid price. Now, if you've ever been to a foreign exchange dealer, you know what I mean. You go into a bank in Manhattan and say, I need British pounds. And you look at the sign and you'll notice that there's actually 2 numbers. Okay, and so you might say to yourself, why are there 2 numbers here? Let's say you walk in the door and let's just keep it simple. And you notice that the prices are listed as 132 and 142 per pound. And you ask yourself, why? Why are there 2 numbers? Okay, so the way it works is the first number is the bid price, and the second number is the ask price. Now, keep in mind, a dealer in foreign exchange is trying to make money. So what that means is they'll buy or sell any currency you want, but you have to expect them to make a profit. So if I want to buy pounds, I'm going to pay $1.42. But if I want to sell pounds, I'll only receive $1.32. So the difference, the 10-cent difference, is where their money's coming from. That's how they make their profits. Without that, then they couldn't exist. Now, the difference between these two is often referred to in finance as the bid-ask spread. Okay, the difference between the two is the bid-ask spread. That's how you can tell how much profit they're making. Now, the size of that bid-ask spread depends on the size of your transaction. So, like for example, if you're only buying 100 pounds, then you'll get this very wide bid-ask spread. But if you're buying 1,000,000 pounds, then what you're going to end up with is a much smaller spread. In fact, let me add this in here. The size of the bid-ask spread depends on the size of the transaction. For larger transactions, the bid-ask spread will be smaller. Okay, so in other words, for a transaction, in fact, let me just show an example. For example, for a $1 million transaction with British pounds, the bid-ask spread might be, and then it'll be much, much smaller. Like instead of 10 cents, it might be a fraction of a cent. Like let's say, for example, and I'm just making this up right now, but you might, instead of what we had before, you might see 1.3829, something like that might be more normal with such a large transaction, because now you're looking at, even though it's a fraction of a penny on each pound, you're still looking at $1 million. So the difference between those two, let me just quickly double check this because I just made this up on the spot. You're looking at $0.002. So we subtract one from the other. So that's, yeah, that's like a tiny amount. 1.3820, no, sorry, 0.002 per pound. But when you multiply that by $1 million, this becomes, and so now we're talking about some real money. $2,000 on a single transaction. So this is why they can afford to do that, because it's so much money. Whereas over here, even if you paid 10 cents per pound, based on 100 pounds, you're looking at a dollar profit or something like that. So that's what's driving these bid-ask spreads, the size of the transaction. So when you see, let's say you go to the internet and you say, listen, I want to look at some exchange rates. I'm interested in traveling. And you look at here and you say, oh, here we go. it would take me $1.39.15 to buy a British pound. That number is not the actual price at which you can make this trade. That is typically the midpoint of the bid and ask spread. Okay, in other words, there's a lower bid price and there's a higher ask price. This is in the middle. This is just there to give you an indication of how strong this currency is. So, yes, so when you see a quote like that, it's typically just simply going to be the midpoint of the bid-ask spread. Or the Wall Street Journal, wherever you're looking at your source, they typically will not give you the bid-ask spread. It doesn't make any sense because it depends on the transaction. So instead, they simply give you the midpoint, which is the one that is going to be common to all these different bid-ask spreads. All right, now with all that being said, if you notice, we're entering into a contract with the dealer. And that means we're dealing in the over-the-counter market. This has nothing to do with the Chicago Mercantile Exchange. This is 100% an over-the-counter transaction. I call up a foreign exchange dealer and I say, you know what? I want to buy 100,000 British pounds in 6 months. What price are you going to offer me? So this is what we mean by a full the over-the-counter market. And in fact, if you look at the CME website, you won't see any forward contracts listed there because they don't deal with them. They only deal with over the exchange traded products. Now, by the way, here's an important piece of terminology that we need to understand before we go any further. You do have the ability with these contracts to either buy or sell the underlying asset. So if you're the buyer, you're said to have a long forward position. And of course, if you're the seller, that must mean that you have the short forward position, and that is exactly correct. So we just want to be careful because the strategy that we employ to hedge our risk will depend, what we are trying to do will determine if we should enter into a long or a short forward contract. All right, now, how do we hedge with these contracts? Now, suppose that let's keep going with the example of foreign exchange. It's a very useful example because the foreign exchange markets are so massive. If you thought those other numbers were big, let's go back to CME. Let's look at some of the daily volume. So that's not it. Yeah, they're talking about the daily trading volume. And these numbers are quite large, but they're pale by comparison to the currency markets. Now, these are derivatives that we're seeing here. In the currency markets, or foreign exchange markets as they're called, the typical daily trading volume with currencies or foreign exchange at this point in time is about $5 trillion a day. That's a lot of trading, $5 trillion. So this is a good example for foreign exchange, for forward contracts, I mean, to illustrate how they work, because a lot of that activity is hedged with foreign exchange forward contracts. Okay, imagine that. $5 trillion changes hands every day in the currency markets. And not only that, but the currency markets don't really ever close. You know, the stock exchanges close pretty early in the afternoon, and they're only open Monday through Friday. But currency trading essentially never stops. So that's a lot of trading. So the contract can be used to lock in the price at which you can acquire a currency or buy it or sell it. Now, before we look at this more closely, we have to introduce a few more key terms. You may or may not already be familiar with these. For example, the words appreciation and depreciation refer to changes in the strength of a currency. Just like anything else, let's say you own let's say you own a nice piece of jewelry that you inherited from your grandmother. The value appreciates over time typically, meaning that it increases. If on the other hand, you have something that loses value over time, then we say that it depreciates. And the same thing holds here. So here's an example. Suppose exchange rate between the dollar and the pound is currently $1.30, and all of a sudden it goes up to $1.35. The question is, which currency became stronger and which became weaker, and also why? So why don't we do this? Let's do a poll. Polls are fun. So let's stop this one and let's start a new one. All right, so just based on this example we just had, which currency it appreciated? In other words, became stronger. Well, actually, I'm sorry, the question has to go down here. That's just the title. Which currency became stronger, meaning appreciated in value? Well, there's only two possibilities. It's either the dollar or the pound. Let's find out which one you think it is. Okay, hold on. So remember, the exchange rate went from $1.30 to $1.35. All right, the voting is in. Well, it turns out that in this example, the currency that got stronger is in fact the British pound. How do we know that? Because it now takes more dollars to buy a pound. Therefore, the pound is stronger, and that also means that the dollar is weaker as a result. Okay, so yes, the dollar is weaker because it now takes more dollars to buy a single British pound. And that means the dollar has depreciated against the pound, while the pound has appreciated against the dollar. They can't both get stronger and they can't both get weaker. They have to go in opposite directions. All right, now think about this situation. What if I'm a US importer and I'm in the habit of buying British goods and then reselling them in the United States? In 6 months, I know that I will need to buy 100,000 British pounds because I've ordered all this merchandise from England that I want to sell in the United States. What could go wrong? Actually, let me add a little explanatory note here. It says here that the importer is exposed to the risk that the dollar will depreciate in 6 months, meaning that the pounds become more expensive. So let me show you why. Okay, so for example, if the exchange rate rises from $1.30, as it just did, per pound to $1.35 per pound, the cost of 100,000 British pounds will rise from, okay, so we have 100,000 pounds times $1.30 per pound, which is $130,000, to $1.35 a pound, which equals 135,000. So yes, the hedger is right to be worried. If the dollar gets weaker, the pounds will become more expensive. What do we do about it? Now, by the way, just having said that though, let me just quickly show you the opposite side of the same coin. On the other, I'll add this as an other hand. On the other hand, if it falls from $1.30 to $1.25, the cost of 100,000 pounds will fall from 130,000 to only 125,000. So the risk goes both ways. If I wait 6 months to buy these pounds, they could become more expensive, and they also could become more inexpensive. So here's the thing, though. As a business owner, or the owner of this business, is not, well, let's just say that the owner of this business is trying to make a profit from selling British goods in the United States, not to speculate on currencies. Therefore, he or she may decide to completely eliminate all foreign exchange risk by entering into a forward contract to buy pounds at a predetermined price or at a fixed price. So in other words, what's happening here is they've decided, you know what, I know that I could make money if I wait, but I could also lose money, and this is not my business. I don't want to have to worry about that. So the hedger, or the owner of the business, enters into a forward contract to buy British pounds, 100,000 British pounds, in 6 months, at a fixed price. Suppose this price is $1.32 per pound. This guarantees that in 6 months, the cost of the pounds will be $132,000, regardless of the exchange rate at that time. So in effect, this is like an insurance policy. You're guaranteeing yourself that you'll never pay any number other than $132,000 for these pounds. Okay, so that is a classic example of a hedge. Now, as another example, this one has some slightly different numbers. Now, suppose that this is another importer. You see the numbers are different, but that's okay. It's the same principle. We decide to enter into a forward contract to buy 100,000 pounds in 6 months. The forward exchange rate in the contract is $1.70, which means that we've locked in a price of $170,000, and that's completely independent of whatever the exchange rate happens to be at that point in the future. So this chart or graph is designed to show you that the hedged position, you're guaranteed to pay $170,000 for these pounds. With the unhedged position, that depends on the spot exchange rate in 6 months. It could go down to 160, it could go up to 180, or anything in between. In fact, it could go even lower or higher than that. So this is the trade-off between hedging and not hedging your risk. All right. Now, what happens if you're the seller if you're an exporter who needs to sell British pounds in 6 months, then you would do everything in reverse. Okay, so here we're trying to wrap this up by noting that hedging the risk of a price increase means you will take a long forward position in that contract. But if you're the seller of the pounds, then you're going to enter into a forward contract to sell pounds in 6 months, which is a short forward position. Okay, because then your risk is that the price goes down. All right, so the two basic positions you might take are, if you're the buyer, you enter into a long forward position. If you're the seller of the asset, you enter into a short forward position, and that will eliminate all of your foreign exchange risk. All right, so now you have a feel for what a forward contract is, why they're so important, and how powerful and flexible they are. Now, it's time to look at the second type of derivative security that we mentioned earlier, and that would be futures contracts. Now, a futures contract in principle is very, very similar to a forward contract. There's a few main differences, a few main institutional details, but the logic is exactly the same. What's different? By the way, this is what you can buy on the CME. Let's see if we can go back there for a second. They don't have forward contracts, so they do have futures contracts. Ooh, what happened? All right. Let's say I tell it I want to look at foreign exchange derivatives. There we go. Foreign exchange futures and options. So what kind of products are they looking at here? So we have, for example, Euro futures, we have Japanese yen futures, we have British pound futures, and we have Australian dollar futures. We have others as well, smaller countries like the Mexican peso, Brazilian real, the Russian ruble, and finally the South African rand. I guess that's all they have. So you see, this is what I was saying before. If you need something else, you have to go, you may either go to another exchange, or else you might try a forward contract where you can choose any currency you like. There is a limit to what you can buy through an exchange like this. They mainly focus on the high volume products, and they sort of ignore the rest of them. So this is what they have to offer. So let's look at the British pound one. So there's a lot of detail. Look at the volume here. Oh my God. That's the number of contracts, by the way. And so we'll come back to this in a minute as we go through this, but all the details are right here. Now, what's different then? Well, first of all, forward contracts are negotiated directly between counterparties, whereas futures contracts are traded on organized exchanges like the Chicago Mercantile Exchange that we see here. Now, the problem with that, though, is that when you're dealing with a counterparty, like a bank, let's say, there's always a chance that the counterparty could go out of business or they could run out of money. So there's a bit of a risk there. There's some credit risk involved with forward contracts. We don't have that problem with futures contracts because they're guaranteed by the exchange on which they are traded. Okay. So therefore, if you want to get rid of all your credit risk, you have to get a futures contract. With a forward contract, you can never really completely get rid of it. Although, I mean, realistically, you know, if you're going to go deal with Goldman Sachs, let's say, or Morgan Stanley, it's not likely that they'll go out of business, but it's always possible. So you never know. What else is different? A futures contract is easy to what we call offset. In other words, if you change your mind with a futures contract, there's an easy way to get out of your position. We call that an offset. Let me show you an example of this. Suppose that you enter into a December gold futures contract on the CME to buy 100 ounces of gold. You promised to buy gold in December. And let's say you decide, I don't really need the gold after all. You can now take a short position in the December gold contract to sell 100 ounces of gold. Now, you have two open positions here, but the cash flows exactly offset each other. So for all practical purposes, you have unwound your complete position. So in other words, right now, the gold that you're committed to buy is offset by the gold that you're committed to sell. And so you now have no position in gold at all. Something like this isn't normally feasible with a forward contract. If you enter into a forward contract to do something, you're pretty much committed to doing it. That means you have more flexibility here. And so that's a very interesting point. Because it's so easy to unwind a futures position, in most cases, the underlying asset is not actually delivered, meaning that the positions are almost always unwound before the delivery date arrives. Where with a forward contract, it's the other way around. I mean, you almost always see delivery taking place because it's so hard to get out of this position. Yeah, that's right. So if you really mean to buy the asset, you might be better off with a forward contract. If you really don't want the asset and you're just hedging your risk, you're probably better off with a futures contract because it's so easy to change your mind. Okay. All right. So what other differences are there? With a forward contract, no cash flows take place until the maturity date of the contract. A futures contract requires us to deposit funds called or known as collateral into a margin account in the beginning, and then every day the value of our position is recalculated. And if we lose money, we may have to put more money into that margin account. Okay. So in other words, with this futures contract, when things aren't going so well, you may have to put more money into your margin account to cover any potential losses. Forward contract, no cash flows happen until the actual final day of trading when you actually pay for the asset or sell it. Let me show you a quick example of this. For the gold contracts on the CME, I looked this up somewhere in the past. Each contract on gold, which is written on 100 ounces, requires you to put $5,500 into your margin account. Now that sounds like a lot of money, but it's just collateral. It's still your money. And also, I mean, let's face it, if gold is selling for $1,700 an ounce, a contract to buy 100 ounces of gold in principle is worth $170,000. So you can see this is not a huge percentage of the contract value. So now there's also what we call a maintenance margin of $5,000, which means the balance in your account can never fall below $5,000. If it does, you have to put more money into your account. Now, the good thing about this, though, is that if your balance keeps rising, you can actually withdraw the surplus if you want to. So imagine now you're buying the gold contract. It's written on 100 ounces of gold. That means every time the price of gold changes by $1, the value of your margin account changes by $100. So it wouldn't take much to wipe out the balance in your margin account. So this is why there's this extra wrinkle, this extra bit of risk involved with futures contracts. You could have temporary downturns in the gold price, which would force you to put a lot more money into your account. That wouldn't happen with a forward contract. And if you can't come up with the money, they will actually close out your account. Okay, so you've got to watch that too. So like here, for example, all it would take is for gold to fall by $10 an ounce to reduce your margin balance by 1,000. That brings you down to 4,500. Now, remember, the maintenance margin is 5,000. That means you now have to put more money in this account, and it has to go back up to the initial margin level. So in other words, you're not just putting back another 500, you actually now have to put back 1,000. And this is referred to as a margin call. The dreaded margin call, or you must put up more money, otherwise your position will be wiped out. Wow. And by the way, this is how Nick Leeson was ultimately caught at Barings. He was dealing with futures contracts, and the margin calls were so large that he eventually couldn't cover them. So this process, which you don't get with the forward contracts, is called marking to market. Okay. That's one of the big differences between forwards and futures, marking to market. So this is one of the risks of taking a futures position that you do not get with a forward position. All right, well, now we're done with the first two of our four derivatives for the evening. The third one is called a swap. And of course, the word swap means a trade of some kind. So with a swap, you're entering into a contract, basically, in which you agree to trade cash flows with a counterparty based on some underlying variable, which in this point in time could be almost anything. Swaps can be written on, for example, interest rates, exchange rates, equities, commodities, almost anything you could imagine. Although the majority of them are either interest rate swaps or foreign exchange swaps, or currency swaps as they're called. These are popular too, but the majority, I would say, are interest rate swaps and currency swaps, because that's where most of the risk is involved, I think. Now, by the way, just want to mention here, a swap is an over-the-counter product. You do not find these on exchanges. Okay, they are, but that's because they typically need to be customized to the needs of the individual hedger. These have been around for a surprisingly short period of time. They got going in the 1980s. In fact, it was an interesting outcome. In fact, we looked it up on Wikipedia one time. Let's just quickly take a look at this. So, here it is. This is the first interest rate swap. There already were apparently currency swaps, but the first interest rate swap was an arrangement between IBM and the World Bank in 1981. They don't seem to have all the details here. What ended up happening is that they basically needed to swap currencies, but it was complicated, but they were able to pull it off. And once people saw that this could be done, they said, you know, maybe we should do this too. And like it says here, swaps have exploded in popularity. 6 years later, the notional value was 865.6 billion. And this, by 2006, this figure exceeded $250 trillion. More than 15 times the size of the US equities market. All the stock markets combined have market capitalizations 1/15 of the volume of trading in swaps. Wow. That's a big number. Whoa. Okay. So what is this all about? Well, first let's take a look at the so-called interest rate swaps. Now, Here, what a typical swap does is this. It enables two counterparties to exchange cash flows based on two different rates of interest, as the name suggests. But the way it's normally structured is that one of those rates is typically fixed, and the other, as you can see, is said to be floating. What does that mean, floating? A floating interest rate. What exactly is a floating interest rate? Well, what that means is that it is reset periodically. Now, the best example of this I can think of is an adjustable rate mortgage. If you get a fixed rate mortgage, the rate will be the same every year. But if you get a floating, an adjustable rate mortgage, the mortgage rate can be reset every single year. And so that would be referred to as a floating rate of interest. Okay, yes, so that's the example I used here, the floating rate mortgage. I think that's something everybody's familiar with. A floating rate mortgage means that the rate changes every year, or I'm sorry, it's called an adjustable rate mortgage, but that just means the rate is adjusted every year. So there do exist securities in the market where the interest rate that they pay is in fact floating. Okay, now the notional amount of the swap on which these exchanges take place is not actually swapped, or it is not actually traded between the counterparties. It's only the interest payments. And even then, it's only the difference between the interest payments that's actually traded between the two counterparties. This keeps the credit risk down to an absolute minimum. There is credit risk here because this is an over-the-counter product. But in order to keep it as low as possible, we don't trade the notional principal underlying the swap. We only trade the difference in the interest rate payments. So you'll see what that means in a minute. Now, the floating rate side of a swap has traditionally been based on a special rate of interest called LIBOR. And LIBOR stands for London Interbank Offer Rate, the rate at which the major London banks borrow from each other. And for many decades, LIBOR was the rate of interest that was used for virtually all floating rate securities. But unfortunately, there was a series of scandals in which British banks, Barclays in particular, was caught manipulating LIBOR rates to earn illegal profits. And so now LIBOR is going to disappear very soon to be replaced with other rates, one of which is called SOFR, which stands for the Secured Overnight Financing Rate. This is implemented by the Federal Reserve Bank of the United States. And so it is not susceptible to being manipulated. If you want to know more about this, there are articles on the internet. Let me just quickly see what we can find. Yeah, it's in Investopedia. It was a highly publicized scheme in which bankers at several major financial institutions colluded with each other to manipulate the LIBOR rate. Of course, in other words, they're trying to make profit at the expense of their customers, basically, or each other. And so LIBOR is disappearing very soon. In fact, it's supposed to be gone by either 2022 or 2023. Wow, so a lot of fines were handed out, and maybe some jail time too. Ooh. But yeah, so we're going to see it gone very soon. And every country has a different rate of interest that will be used to replace LIBOR. It's sad because it works so well for all those decades. LIBOR had been around since the 50s. And sadly enough, I guess the temptation was too much for these crooked banks. And before you know it, we've got a scandal on our hands where they're playing games with the LIBOR rate. But Anyway, so what we have here now, by the way, this is secured overnight financing rate. This ties into this notion of a repo or repurchase agreement, which is an arrangement in which low cost collateralized loans are made between banks in the United States, at least. Let me just show you a quick example of how this would work. And then this tells us what SOFR actually means. So imagine you've got two banks. You have Bank A, they have a treasury bill in its investment portfolio worth $1 million. It needs cash in a hurry, but it doesn't want to sell the treasury bill. Let's say they only need the money for a few days or even one day. They approach Bank B, who agrees to buy the bill for $1 million and then sell it back to the Bank A. For $1,500,000 the next day. So in effect, Bank A has been able to borrow $1 million for one night at an interest cost of $500. That seems like a lot for an overnight loan, but let's see, what percentage is that? That's about 1/20th of 1%. If you annualize that, it works out on a yearly basis to about 18.25%. Probably it would be lower than that. I just made these numbers up. Typically, these loans have very low rates of interest. Like, for example, maybe it would only be $100, let's say. But Bank B has earned $500 by simply making a risk-free overnight loan. It's risk-free because there's collateral involved. If Bank A doesn't want to buy the treasury bill back, or they can't, we can sell it in the market. So there's no risk to Bank B. It's a collateralized loan. So any interest that can be earned is essentially free money. So this is referred to as a repo or repurchase agreement. And the SOFR rate refers to the market where repos take place and treasury securities are being used as collateral. So that SOFR rate is what they're charging each other for these collateralized repos. Not just loans, repos, meaning that they are collateralized, which means they're very low risk. And so the SOFR is very close to being a risk-free rate of interest. All right. Why would anybody then want to get involved in a swap? Let's find out. Let's look at a quick, simple example. A corporation issues $100 million worth of debt with the following terms and conditions. It's a 5-year bond that they're issuing. The coupon rate, it's a floating rate bond, by the way, because the coupon rate is LIBOR plus 2%. Now, the problem with something like this is that if interest rates go up, they're going to pay more interest in the future. And so maybe they don't want to do that. In fact, let's just say that the corporation decides, maybe we shouldn't have done that. If only we'd given out a fixed rate bond, we wouldn't be in this mess. So why don't we do this? We'll enter into a swap with a dealer in which we are going to pay a fixed rate of interest to the dealer. And in exchange, they'll pay us back a floating rate of interest, which resets every year. That rate will be LIBOR. Okay, now, the bond itself that they issue is worth $100 million. So that means that the notional principal is $100 million. That is the part that's never traded. But the interest payments are based on that $100 million. So let's assume that we enter into this deal. We find a dealer who let us do the following. We'll pay the dealer 6% in exchange for LIBOR every year for the next 5 years. Now, since the company that issued the bond has to pay LIBOR to our bondholders no matter what, look what's happening with this situation. If LIBOR goes above 6, we will get the difference between LIBOR and 6% from the dealer to offset our higher interest expenses. But on the other hand, if LIBOR drops below 6, we can't save any money because we now owe money to the dealer. And so the total cost, any way you look at it, will always be 6%. So that could be a good thing and it could be a bad thing. Okay, so let me show you a diagram. I think it'll make it easier to follow what we're talking about here with a diagram. So here we go. Here's the corporation. And you can see that the corporation is committed. Oh, what just happened? Okay, we have to pay LIBOR plus 2% to our bondholders based on $100 million. We pay 6% to the dealer, but the dealer sends us back LIBOR, again, based on 100 million. So what's actually happening between the dealer and the corporation is that when LIBOR is below 6%, we owe the difference to the dealer. If LIBOR goes above 6%, the dealer owes us the difference based on a $100 million notional principal. So guess what's happening? If you look at these cash flows, the firm is now paying LIBOR plus 2% to the bondholders and 6% to the dealer. What do they get back from all this? The dealer gives them LIBOR, okay? So therefore, we end up with a net cost of 8%. Okay, so we get LIBOR from the dealer. We pay LIBOR plus 2 plus another 6 to the dealer. So the net effect is that now, instead of paying LIBOR every year, no matter what LIBOR is, this company only has to pay 8% to cover their debts. Now, that's still a lot of money, but at least we know how much it is in advance. There's no more risk. It can't go up if LIBOR rises, but it also can't go down if LIBOR falls. That was the purpose of all of this. We're protected from rising rates, but we also cannot benefit from falling rates. So we've locked in the rate at which we can pay interest on our bonds. Now, it turns out that the swap is very much like a forward contract, except that there's more than one set of cash flows. So in effect, a swap is equivalent to either a series of forward contracts, or we could think of it as the trade of a floating rate bond for a fixed rate bond. Either way, we'll get the same results. All right, so there's more examples here. I just realized it's getting very late here. We're having so much fun. I want to run through some of these other examples, plus we want to introduce currency swaps, and then we want to get as far as we can into our discussion about options, because they are by a long shot the most complex but most important of all these products. So if we don't quite finish that tonight, we can certainly wrap it up next week before we start the session 2 material. All right, so why don't we do this? Why don't we stop temporarily right now? We'll have a quick break. Let's say 15 minutes. That should be enough to get some stimulation, because I know that you're at home right now. And then we'll carry on with the rest of these examples. Okay, so I'll see you in about 15 minutes. Okay. All right. Okay. All right, so let's look at a few more examples of these swaps, and then we can at least get started with options. So how about this case? A pension fund owns a floating rate bond issued by a corporation where the notional is $1 million and it matures in 2 years and it pays LIBOR plus 3%. Now, from the pension fund's perspective, that means that if rates go down, they'll be earning less money than they otherwise might have from this bond. So they're worried about rates dropping. So they decide to enter into a swap in which they can lock in a fixed rate of interest. So imagine that they go into a swap with a dealer, in which they pay floating to the dealer and they receive fixed back from the dealer. Okay, so let's say they arrange a deal where they pay LIBOR for the next 2 years, and in exchange, they receive a fixed rate of 7%. So that means since we're paying LIBOR, if the fixed rate rises, or if LIBOR falls below the fixed rate, that means that we'll be owed money from the dealer. Or if LIBOR rises above 7%, the dealer, we have to pay the dealer. Okay, so again, it's always the difference between what we're paying and what we're receiving that's actually changing hands. So let me just show you what this looks like. So the corporation is actually paying LIBOR plus 3% to the pension fund. Now the pension fund in turn swaps this LIBOR to the dealer and in exchange receives back 7%. So when you look at these arrows, you'll see that they all cancel out, the LIBORs cancel out, and we end up with a net revenue of 10% per year, no matter what happens to LIBOR. So in other words, if these two LIBORs cancel each other out, we're receiving 3% from the corporate bond, another 7% from the dealer. So we end up locking in a 10% return every year for the lifetime of this bond. Not bad, huh? Okay, now what about a currency swap? This is a little bit different because it's not all denominated in dollars, obviously, as the name suggests. So with the currency swap, what we're effectively doing is we're trading cash flows based on two different fixed rates of interest, where those interest rates are tied to a different currency. All right, now here, unlike with the interest rate swap, the notional principal is traded back and forth between the two counterparties. All right, so here's an example. A U.S. corporation wants to invest in a 5-year, 100,000 pound bond with a 6% coupon rate issued by a UK corporation. But we do not want to bear any foreign exchange risk. In particular, if the dollar gets stronger while we own this bond, it will reduce the dollar amount of our pound payments. So we'd like to lock in a rate at which we can invest or earn our pounds. And so the way it's structured now, every year we're entitled to receive a 6,000 pound coupon, which comes about from the product of 6% times 100,000 pounds. Well, now there's the problem. How do we know how much that'll be worth during each of the next 5 years? We don't know. So if we assume that the current exchange rate is $1.90 per pound, then if that stayed that way, then every year we would be getting a guaranteed $11,400. In other words, we multiply 6,000 pounds by $1.90 per pound. And that's nice, but we can't count on that happening. The exchange rate can change every single year. For example, what if it goes down to $1.80? If the dollar gets stronger, as we saw earlier, then our dollar payments are only worth $10,800 instead of $11,400. So even with the same number of pounds, the number of dollars will be lower because the dollar got stronger. That's what we worry about. Now, if the dollar gets weaker, let's say the exchange rate goes up to $2 a pound, then we'll end up with $12,000 every year. And that would be wonderful, but we don't want to take any risks. So what do? Well, we approach a dealer and say, listen, we want to pay fixed rate of interest to you, the dealer, based on a notional principal denominated in pounds. And what we want you to pay us is a fixed rate of interest denominated in dollars. That way, the number of dollars we earn every year is the same no matter what happens to the exchange rate. Okay, so let's look at this diagram. So we start out, we agree to pay 6% to the dealer in pounds, and they in exchange will pay us 5% in dollars. The spot exchange rate is currently $1.90 a pound. So we spend $190,000 to buy this bond. Because the current exchange rate is $1.90 per pound, this 100,000 pound bond will cost us $190,000. So the interest rates in the swap are based on these two amounts. The dollar rate is based on $190,000, and the pound rate is based on 100,000 pounds. So at the beginning or the end of each year, we, the American company, are paying 6,000 pounds to the dealer, and we're getting back $9,500. That's locked in. And we also trade the notional principal at the beginning and the end. So therefore, the intermediate cash flows look like this. We're getting 6% from the UK bond, which we swap to the dealer, the exact same amount, so that our net revenues are now 5% in dollars every year. Or, in other words, 5% of the dollar value of this bond, which gives us $9,500 per year. And that means no foreign exchange risk. So that's the whole point of this. Okay, so once you've locked into this position, though, of course, you can't benefit if the dollar gets weaker. You're locking in the rate that you'll earn from this swap and the bond. You've gotten rid of all of your risk, and that's exactly what you're hoping for. Now, sometimes swaps can be used for other purposes. For example, let's look at this one. Let's say that we have the ability to borrow for 5 years. We're an American corporation. We have the right to borrow for 5 years at 1.5% in the United States, but because we're a multinational corporation, we can also borrow for 0.5% a year in Japan. Well, here's what we'd like to do. We'd like to try to take advantage of this. We want to borrow in yen in Japan and then turn them back into dollars. Okay, suppose we're borrowing the money to pay for an expansion of our business. We need dollars. We can't spend yen in the United States. So we'll borrow the yen in Japan, but then we'll immediately convert them back into dollars. And so what we're trying to do is reduce our borrowing costs by paying 5% or 0.5% in yen rather than 1.5% in dollars. All right, so here's what they do. They issue $1 million bond. Actually, it's $1 million worth of yen. In other words, here we have the yen-dollar exchange rate is 100 yen per dollar. So this bond that's worth $1 million US is actually worth 100 million yen. So we're borrowing 100 million yen with an interest payment of 0.5% per year. Then, based on the same notional principle, we enter into a swap with the dealer in which we're going to pay 1% in dollars to the dealer, and they will in turn pay us 0.5% in yen. All right, well, let's see how that looks with our diagram. Yeah, this will do it. So in other words, we're paying 0.5% on our loan. We're receiving 0.5% from the dealer, and we're paying 1% to the dealer. So the net borrowing cost is not 0.5% in yen, but 1% in dollars. And since it's $1 million bond, that means we're paying $10,000 worth of interest every year on this bond that would have cost $15,000 a year if we borrowed in the United States. So instead of gambling on the future direction of the interest rate, we're basically lowering our interest rate costs by entering into one of these swaps after borrowing in a low interest rate currency and lending in a high interest rate currency. So there's a lot of things we can do with these currency swaps, not just, locking up the rate from a bond that we happen to own. All right, so we've saved the best for last. We're going to look now at options. Now, options, the name kind of tells you what you need to know. Unlike the other three securities that we looked at, forwards, futures, and swaps, those are contracts. Those are binding obligations to do something in the future. Unless there's some way to offset them, you are obligated to do what it says in your contract. Now, we know that with futures, it's easy to unwind them, but it's still a binding contract. The option is the only case where we have the right to change our minds. And that's why they're called options, because whatever you're supposed to do is optional. All right, so let's get back to this. Hold on, I lost my place. All right, so really just barely going to get started here with options, because next week we'll have a lot more content with options. I just wanted to briefly introduce them to you. An option is a derivative security like the other ones, but this one gives you the right, but not the obligation to buy or sell an asset in the future at a price agreed on today. So in effect, an option is like a forward contract where you have the right to change your mind. Now, you might wonder, well, then why don't we always use options instead of forward contracts? The drawback to an option, actually, let me throw this in here. The main drawback to an option is that unlike the other derivative securities, the option must be purchased. So there is an actual cost to hedging or speculating with options. Now you might wonder, well, what's going on with the others? Well, the forward contract has no cost at all. The swap has no cost at all. The futures contract has a margin requirement, but that's just collateral. It's not money that you're actually paying to buy the contract. It's just collateral. It's your money still. This is different. You actually have to pay for an option. And they can be very expensive. All right. And by the way, here's an interesting side note, though. Unlike the other three, we can actually easily find information about options in the marketplace. There are many different websites, for example, finance.yahoo.com. And if you look here, let's say I go to look at Apple. AAPL. I knew that was wrong. Apple stock has options written on it. And there's a list right here. And if all you want to know is what kind of options we can buy on Apple stock, here's a list right now of options that you can buy right now if you wanted to. And all of these options give you the right to either buy or sell Apple stock in the future. And you can see there's a lot of them that are available because this is such a very heavily traded stock. So the option, again, gives you the right, but not the obligation to buy or sell an asset in the future. The price is settled on today. So it's structured a little bit differently than forwards and futures and swaps. For example, we know about the price, but an option can be characterized by several different features. For one thing, what exactly does the option give us the right to buy or sell? Whatever that is, it's called the underlying asset. Now, as it turns out, options, just like the other derivatives, can be available on many different underlying assets. For example, we see a lot of trading in these types of options. We have options on interest rates, we have options on currencies, on equities, on equity indexes like the S&P 500, on precious metals like gold and silver and platinum. And then, interestingly enough, you can actually buy an option on a futures contract. Now, that's kind of odd. And just as a little quick explanation here, an option on a futures contract provides the right to enter into a long or short futures contract with a predetermined futures price. So these types of options are known as futures options. Interestingly enough, futures options. Now, you may say, well, that seems unnecessarily complicated, but futures options are extremely popular. In fact, at this point in time, most options are actually futures options. Not all of them, but many of them. Okay, so that's one of the more popular types of options. Also, which I didn't mention here in the slides, another underlying asset can be a swap. Okay, the underlying asset can also be a swap. These types of options are known as swaptions. Yes, they are. That's the actual name, swaptions. Swap options. Okay, so you can imagine that there's many different options that are available, and the underlying asset can be a forward contract. These types of options are known as forward options. Okay, so all of them are available. So in other words, you can have derivatives based on each other. And not only that, but here's where it gets really weird. An option can be bought, underlying asset can actually be another option. These types of options are known as compound options. Okay, in other words, for example, an option may provide the right to buy another option at a predetermined price. So, and you can see it can get very messy. And then the other options can be futures options. So you now have an option on a futures contract. So it can get very messy very, very quickly. Very messy. Most of the trading, though, is in the simpler types of options, because people can run into trouble if they start buying options that they don't understand. And in fact, this is how people like Nick Leeson have lost enormous sums of money, by not understanding the securities that they're actually trading. Okay. Anyway, so the price at which you're allowed to buy or sell the option, or the asset rather, is often referred to as either the strike price or the exercise price. I do not know the origin of these names, but this is what it's called. Now, there's also with each option associated what we call a maturity date. That's the last day in which the option trades. Okay, so the owner of the option must make a decision whether or not to use the option, i.e. exercise it, by the time of the maturity date. If not, the option expires and loses all of its value. You got a fixed length of time in which to make up your mind. So if not, if you allow it to expire, then it has no value. This is something you didn't have to worry about with the others, forwards, futures, and swaps, because you're required to do whatever it is you've entered into this agreement to do. Here you have the decision to make, and you may decide to just not bother. You may say, I don't want to exercise this option because it would put me in a worse position, or I simply no longer need the underlying asset. Now, the two basic types of options you typically run into in the market, the one that gives you the right to buy something is known as a call option. And the one that gives you the right to sell something is referred to as a put option. And again, I do not know the origin of these names. This is what they've always been called. Calls and puts. Calls give you the right to buy, puts give you the right to sell. Now remember, so this is the equivalent. Remember with the forward contract, the one that gives you the right to buy is called a long position, and the one that gives you the right to sell is a short position. Here, the notation is a little different. We refer to these as calls and puts. Now, here's another classification scheme that we need to be familiar with. In addition to everything we've seen, the two major categories for options are the following two: European style and American style. A European style option can only be exercised on the maturity or expiration date. You get one shot at it and that's it. The American style option, on the other hand, you can exercise it anytime you please, right up until the maturity date or expiration date, after which, of course, it becomes worthless. So you probably wonder, well, why would we ever buy a European option? Well, here's why. Most options in the market either fall into one of the two categories. For example, interest rate options tend to be European style. At the same time, though, equity or stock options tend to be American style. I'll tell you why, and we'll see later on as we go through this. Because with Europe interest rate options, you're typically trying to hedge the rate of interest on a specific date in the future. So it doesn't really do you any good to be able to exercise it early. So it's usually sold as a European style option. With the stock options, though, it's valuable to be able to sell or exercise early. So they tend to be American style. And so here's an important detail here. Because American options are more valuable than European options, they are more expensive to buy. Okay, so in other words, one reason why, one thing that distinguishes the two types of options is the expense. As we'll see in a minute, we know that we have to buy an option. So American options are more powerful and more valuable, which means that they're more expensive. So that's the trade-off. Okay. Now the premium, this is, by the way, this is where all the rocket science gets involved with option pricing theory. You probably heard stories about how people who study or analyze options or trade them work on Wall Street, and they're usually math whizzes. This is where all the math comes into play, figuring out the proper value or price of an option. The price of the option is often called the premium, and figuring that out is a very challenging thing to do. As a matter of fact, as we'll see in a later section, first let's explain why this is happening. Unlike the other derivatives, with an option, there's a limit to how much you can lose, but there's no limit to how much you can make. And that's an incredibly valuable feature. This is really what you're paying for when you buy an option. Okay, so that's why, unlike the others, we have to pay for this. Now, the premium itself is a very challenging thing to figure out. In fact, the first option pricing model that was published in the 1970s was by researchers named Black and Scholes. And this Black and Scholes model turned out to be so important and so valuable that, let me just mention this right here, the developers of the Black-Scholes model were ultimately awarded the Nobel Prize in economics due to the extreme value, extreme importance, I guess I should say, of their model. The Black-Scholes, let me specify, this is the Black-Scholes option pricing model, were ultimately awarded the Nobel Prize in economics due to the extreme importance of their model. Before that came along, it wasn't realistically possible for people to trade options because nobody really knew what they were worth. But their research showed the way to determine how much an option should trade for in the marketplace. And the framework that they developed proved to be important for deriving prices for other derivatives models as well. So it wasn't just for options, it was for just about any category of derivatives you could imagine. All right, so now that was our quickie introduction to derivative securities. Now, that was our section 1 notes. They went a little faster than I expected. What I'd like to do is at least take a peek. I don't even remember what was in section 2. We're going to start getting involved with pricing. Okay, so you can see with all my handwritten notes here that all of a sudden we're going to have a lot more complications. This week we really didn't need our calculators or Excel, but that will certainly change next week, as you can plainly see. It won't be too painful. I mean, as long as you have a halfway decent calculator, or else if you have access to Excel, you won't have too much difficulty, but you can see the math suddenly starts to become a big deal. Okay, let me just do something here. Okay, yes, so there'll be a lot more calculations next week. And so we're going to be looking at how forward prices are determined. And we're also going to, let's see, what else are we doing next week? We're basically looking at a more detailed look at the differences between forward and futures contracts. We're actually going to see how this marking to market process works with actual examples. So in other words, we're actually going to do a lot of numerical analysis of the topics we've been covering this week. Yeah, look at that. Ooh, lots of numbers next week. And I'm also quickly, whenever appropriate, I'll be quickly reminding you about different statistical concepts that you will need throughout the rest of the course. And let's see, what else are we doing? We're looking at some hedging strategies. Yeah, we're going to do a lot of it. But now this is all to do with forwards and futures. I do believe that we will not do any more swaps until week 3, and then no more options until week 4, it looks like. So let me just double check. I think 3 is just all swaps, although these are fairly complicated products. And then I think in week 4, we'll actually return our discussion to options. All right, let's see. Yes, we'll be getting an opportunity to take a much deeper look at options markets and how they work, and some basic trading strategies that we can carry out with options. So yes, we're going to get deeper and deeper into this material. So most likely these results will be derived with Excel. And also don't forget, right off the bat, there's an assignment here. Let's take a look at it for a second. Let's see what you're being asked to do. Oh, okay. Ooh, you know what? You know, I just realized something. I'm not sure if we introduce this concept. You know what? I'm not so sure that we did this first question during our notes tonight. Ooh, it looks like I've kind of screwed this up a little bit. I don't think that we've discussed this first question. So I'll tell you what, why don't you just do parts 2 and 3 and you can hand them in by emailing them to me. We'll save this one for a later assignment because I'm pretty sure we didn't do this yet. I don't know what happened there, but I don't believe we've covered that topic just yet. No, I don't see it here. All right, so I'll tell you what, just do the second and third questions from the first assignment for next week. And then every week, I believe we have a new assignment. Some of them are shorter than others. But, whoops, yeah, I think we'll be ready for it after week 2, though. Yeah, this is right. That looks a lot more like it. All right, so that's what we'll do. All right, so now I know it's a little early, but I'm sure you're kind of worn out here. So unless you have any last minute questions, why don't we knock it off right here? And then I'll send you the second week's notes and the assignment. And between now and then, next week, what you should do is, make sure you understand what we did tonight, and also take a look at what's coming up in week 2 so that you'll be ready when we start next Monday night. And also, of course, do the assignment, but not question 1. All right. So other than that, unless there's anything else anyone wants to discuss, I'll see you all next Monday. Next Monday.
Excuse me.
Yes.
Will you send us the updated PowerPoint from tonight, or are we just?
Yes, I'm going to change the title of it. And so I'll post what I will call or send you updated. How about that? Session 1 updated, because I did add a lot of good stuff to it. So this way you'll know which is which. And I'll
Awesome,
send that out to you as well with the week 2 notes. How about that?
Perfect. Thanks.
Okay, good. Anyone else?
In the syllabus, it just says that you want us to send the homework assignment like the day before the next class.
Yeah, that's fine. It doesn't have to be any earlier than that.
Okay, thank you.
Okay, anyone else? Excellent. All right, so I'll see you all next week. All right, good night.
Thank you. Good
All
night.
right, bye.
Thank you.
See you later.
Thank you.
Bye. You're welcome.
Good night.
Night.